Hey guys, welcome to the next lesson. This lesson will be following the previous lesson, which was on a company balance sheet. So we've answered question 3.1 of the November 2017 question. And then this question we're going to be answering question 3.2 and question 3.3. This is obviously a little bit harder because it's a complete balance sheet that we have to complete. And you know something about the thing that we know about balance sheet, it's really hard to make them balance. So I'm going to need you to be very attentive and make sure that you're grasping everything that we go through in this lesson. So let us jump straight in. Cool. So what we're given in this question paper, obviously it's based on fixed assets, balance sheet, and audit report. And then the following information relates to audit Ltd. So this is obviously a public company. And then they say the financial year ended on 28 February 2017. This is going to become very important to note. And then the first question referring to information B, and they say calculate the missing numbers A to E. We've done that in the previous video. And then what I've done just here is to put these here because we may need them when you do the balance sheet. Cool. And then the second question, it says complete the balance sheet / statement of financial position on the 28th of February 2017 and show your workings. All right. In this other page here, I do have an answer sheet for this balance sheet. So you can see here that you've already been given like the amount for inventory, and you've already been given an amount for retained income, and then you just have to fill in the missing stuff that you can fill in. So what I would advise you to do when you're faced with these kind of questions is to be very patient. You have to answer firstly what you know, and then you have to finish off with what you don't know, because not everything is going to be clear-cut given. So you have to really capitalize on the stuff that you know, and then once you've exhausted all information, then you can start going for the stuff that you don't know. There's a lot of balancing that is going to need to be done, and you need to be patient, and you need to make sure that you're answering each and every single line here, because these lines are very dependent. So if you don't answer here, then it means that you can't equity, non-current liabilities to get the total equity and liabilities. And when you do not do that, you lose marks. Whereas if you had gotten a wrong amount for shareholders' equity and get a wrong amount for non-current liabilities and get a wrong amount here, the fact that you knew that you have to add the 3 to get to the total, you still get the 1, which is called a method mark. So just make sure not leaving anything blank. If blank and you don't know what to do, just put a random number in and then work with it throughout and apply it consistently. Cool. Out of the balance sheet, so the obviously starts with assets and then it goes into non-current assets. And then after non-current assets, current assets, and so forth. So the first non-current asset that we have is tangible assets. So this is your land and buildings, your vehicles, and your equipment. So I'm going to say tangible assets. And also the thing about non-current assets, it means that they will be with the business for more than a year. If we go back to, because we had a note that was given assets and answered all these questions, and the carrying value, the total carrying value that we did calculate on A is this one. So it's 2,981,290. So we don't have to make another calculation here again. We can just say 3.1 P to just show where we're getting this one from. And also the nice thing here is that if you had gotten the amount wrong when you were calculating on the previous question, but you're able to apply it consistently, you get the mark for putting it here. So it's going to be 2,981,290. So 2,981,290. That's the amount that you're gonna be going for. Cool. And then the other assets that you're gonna have, let us just look in this. So we told about a fixed deposit, its carrying amount, but it is not given. So for now, what I'm gonna do is I'll just say financial asset fixed deposit. And then let us look for information that can help us to find the fixed deposit. So obviously in this it's not given. So let us go through some of the information. B has nothing to do with financial assets. And then the other information, depreciation on vehicles, that is nothing to do with financial assets. The company purchased 2 vehicles, nothing to do with financial assets. Extract from fixed asset register, so nothing to do with assets still. The electricity account for 5,000, nothing to do with financial assets. Provision for bad debts, still nothing to do with financial assets. An additional insurance policy, nothing to do with financial assets again. And then the rent for February has not been received yet, nothing to do with financial assets. Net profit after tax was calculated after taking into account. So still nothing to do with financial assets. And then 75% of authorized 900,000 shares wasn't issued. The directors declared. So also nothing to do with financial assets. And then extract from big loan statement. So this is a loan statement, and also it's not a financial asset. And then even the 2 last bit of pieces of information, they have nothing to do with financial assets. So what do we do in this case? We move on. So we don't put a number in yet, but we move on. And then when we come back to fill in all the gaps, we might have to make up a number. But for now, let us just keep continuing to the stuff that you can be able to obtain. So the other thing that follows then is current assets, inventory. So we don't need to calculate inventory, and they've already given it answer book. And then there's trade receivables. Trade receivables. Let's see if we can find information that can help to calculate what trade receivables are. So if we go back firstly to the extract of the trial balance. So here we have an amount of net trade debtors, 67,200. So let us start with that amount and just open a bracket. And say 67,200. And then let us look at the additional information that will be given as a result of the whole thing. So firstly, we can start with the SARS provisional payments, but let's finish with it because it can either be a liability or it can be a current asset. But let's finish off with it instead of starting with it. So the first information is about fixed assets, and then number C, electricity account for February 2017, 5,600 was still outstanding. So that relates to a liability. So that liability cannot be trade and other receivables. That's trade and other payables, in fact. Then information D, the provision for bad debts must be increased to 270. So if we need to increase the provision to 270, it means that we must subtract our net trade debtors further. So what we need to do then would be to say, because if when you provide for debts that might actually result in bad debts, when you increase that provision, you need to also reduce your trade and other receivables. And if you decrease that provision, then in that case you can add, because now you have a lower provision. It increases trade debtors. And then moving on to the next question. They say here, an additional insurance policy was taken on 1 November 2016. The annual insurance premium was paid. The annual insurance premium of 10,200 was paid and recorded. So in this case, this is the business took out an annual insurance policy for 10,200. It took it out on 1 November 2016. We know that our financial year ends on the 28th of February 2017. So for this year, this insurance policy would count for November, December, January, and February. So it would count for 4 months, and then the other 8 months are prepaid. And you know that prepaid expenses fall under trade and other receivables. So in this case, I'll just do like what we need to do then in this case. Let's just go to the answer book. So, I mean, there's not a lot of space here, so you're gonna have to work with me, guys. So what I'm gonna do, I'm gonna just write the calculation here and take the final amount. So what you need to do here is to take that 10,000. So let's do this. So we're gonna take the 10,200, and then we're gonna divide by 12 because it said that it's an annual insurance amount. And then we know that the months that belong to the current year, it's 4 of them, meaning that the rest of the 8 months, those are the ones that are prepaid. So in order to prepaid expense, we would need to multiply this by 8. So we need to multiply by 8, and when we multiply by 8, then we get 6,800. Or we will add to our trade and other receivables. Trade and other receivables will add 6,000. We'll add 6,800. And then let us look at the other information as well. So they say here the rent for February has not yet been received. So that is an accrued income. So if you're renting out your premises and then someone doesn't pay you, you've earned the amount, but it is not received yet. So it creates an asset there because that amount is now receivable. You know, so accrued income, and on top of that information, they say rent increased by 15% on 1 July 2016. So we know in this case that the rent that has been paid for 11 months, but we cannot simply take the rent income here and just divide by 11 because the rent income has not been consistent throughout the year. At some point of the year, the rent will increase by 15%, and therefore we need to take one into account as well. So this is a bit tricky to calculate, but let us try and calculate, and also just try and be patient with it, guys, and not drop. So the rent for February 2017 has not yet been received. So now we've established that rent has been paid for 11 months. So the first month of the year is obviously March. So for March, April, May, and June, so the first 4 months of the year, the rent was being paid at 100%. So that's what I'm going to say. So I'm going to say, let's just do this here. I want to try and calculate the whole amount here. Because there's just not enough space to be able to calculate all these things. Okay, no, I don't think it's going to work. Let's close that. So what we're going to do, we're just going to go to the bottom of the page and work out this calculation. So we know that from 1 March to 30 June, the rent is 100%. 100% month. And therefore, if it is 100% a month, then it means that when we say, and that is 4 months, so we're going to say 4 times 100, that will give us 400%. Then what you need to do is to say then the rent from 1 July 2016 up until 31 January 2017, up until, because we know that has not been yet. And they told us that from then it was increased to 115. So we're going to say we have 115% a month. And that is 7 months. So what you're going to do in that case is to say 7 multiplied by 115. That should give us a total of 800. 800%. Let us just so that gave us a total of 805%. And what we need to do then is add both. So we'd say 400 plus 805 would then give us 1205%. And that 1205% is equal to total rent amount in rands. The total rent amount is 108,450. And then after that, what we need to do then would be to take, so what we want to calculate obviously is the rent for February. So the rent for February is 15%. We already know that because the rent increased from 1 July. So 1 January 2017, the rent is 115%. So what you're going to do would be to say 115, and then you're going to divide by the total amount. The total amount, you know, in percentage terms is 1.5, and then we're going to multiply that and then we're going to get 10,350, and that for February 2017. So it's been the same as 1 July 2016. We don't need to calculate the amount before the increase. If we wanted to, we would, but we don't need to. So we got the 10,350, and obviously it will increase our and other receivables. So we're going to come here at 10,350. So you're gonna add here 10,350. Let's just move it a little bit to make sure that it does fit. So yeah, we got it now. And therefore the total for trade and other receivables would be 84,000. Would be 84,080. That would be the total. And then we move on to cash and cash equivalents. So cash and cash equivalents, let us start in the trial balance again. So when it comes to cash and cash equivalents, we have bank and it's able, but it's not giving us anything else, not been given cash flow to anything. And none of this information, we've already gone through it, and there was nothing that was leading us to what we can calculate bank to be. So given this, we will not do anything with this information. But just before we move into equity and liabilities, I would like to just test something to see if for SARS income tax, whether we got a liability or we have an asset. So provisional payments that we've made during the year for tax, we've made a payment of 209,000. But now we need to calculate what is the actual tax for the year. So they gave us here that net profit after tax. So note they didn't say net profit before tax. They said net profit after tax is 510,000. And then they say it was calculated after taking into account all the adjustments above. So everything has been taken into account. And then they say income tax is 30% of the net profit. Cool. So what we need to do then, we need to make a calculation. Let's just do a calculation. We'll do the calculation just here. So we're going to say 518,000 multiplied by, since we're looking for the 30%, we're calculating what is the tax for the year. So we're going to multiply it by 30%. But you have to remember that this is not the net profit before tax. So we won't divide by 100, but we'll divide by 70 because 100 minus 30 is 70. So we divide by 70. Sorry, we close the bracket. And that will give us 222,000. So it gives us 222,000, and we've made payments of how of 209,000. So we've paid less tax to have. So in this case, we do not have an asset, but we have a liability as income tax. So we can close that and go to the answer book. There's also just no income tax. For now, there's nothing else that is in we need to do, so we need to move on. And also, if you can see, we can't even have like a total for current assets and non-current assets. So we do not have a total for non-current assets. But as I said, guys, you need to be patient when you're doing these kind of questions and not want to think at the same time. It will take time. So let's move to equity and liabilities and see what you can find. So here we have shareholders' equity, ordinary share capital, retained income. So we've been retained income already as 520,000, and then you need to calculate ordinary share capital, and so that you can be able to get shareholders' equity. So let's go and try and calculate that information. So if you go to the balance sheet account section here, ordinary share capital question mark, so we don't know. And then let's move and try to find it. So the first piece of information obviously is just the balance sheet and then the fixed assets. They're not giving us anything. The electricity account, the provision for bad debts, no insurance, no the rent, no net profit. It's not giving us anything. And then I think the piece of information that at least would get us closer to what you know is information H. So information H is telling us here that 75% of the authorized share capital of 900,000 was an issue. The directors declared a final dividend of 24 cents per share. So what we need to do in this case, let us just calculate how many shares are actually in issue. So to get shares that are in issue, we would have to say 75% multiplied by 900,000, and then we'd know that the shares that are in issue is actually 675,000. Okay. So there are 675,000 shares in issue, but it's not giving us anything still because what we're looking for here is how much were they sold for, and then once you know how much they sold for, we'd multiply by the price to get the share capital. So we still information. They say the directors declared a final dividend of 4 cents per share. So this is not giving us the information we want. And then we're given an extract from the loan statement. Still nothing we can use. And then this is another piece of information that we can use. So here it says the net asset value per share. Net asset value per share is 620 cents. So this is how the net asset value is calculated. It's shareholders' equity. So I'm just going to say SE. So it's shareholders' equity, which is shareholders' equity divided by number of shares in issue. And then multiplied by 100%. And then we know that it gave us a total of 20. And then if we put everything into perspective, then what we need to do, obviously, say, well, shareholders' equity, that is what we do not know, but we do know the number of shares that have been issued, so 675,000, and then we multiply that by 100, and so if you multiply that by 100, we get a total of 620. And then you just have to work this out. So what you need to do there would be to multiply the left-hand side with 1 over 675,000. So that the you have to multiply the left-hand side by 675,000, and then also multiply by 1 over 100. So in this case, what I would do, this is just maths, guys. So what we'll do in this case, we'll just work it out this way. So I'd say 675,000 divided by 100, and then let's just put some brackets. And then we'll say multiply by this, multiply by the same thing that we had above, and then we'd say is equal to 620. Let's do it like this. So we'd say it's equal to 620. Obviously, what you do on the left-hand side, we must also do on the right-hand side. Then we'd say the right-hand side also would multiply by the same thing. And then we know that now we have 675,000, 675,000, and then 100 would cancel 100, and then we'll be left with shareholders' equity, and our total for shareholders' equity will then be 4185 thousand. So that's 4,185,000. So this is maths, guys. You need to be also just good at maths when you do these kind of questions, as we've worked it out now. And so now that we've got this information here, we'll just go here. So the calculation that would just be to say, I'll just say 620 multiplied by 675,000 over 100. And then we know that obviously we will not put this as ordinary share capital because the formula includes all types of equity. So it includes retained income and ordinary share capital. So in this case, we are getting the total of shareholders' equity. And now that you have the total of shareholders' equity, you'll be able to calculate the share capital. And the share capital in this case would then be 415,000. Subtract 520,000, it just becomes and the amount is going to be what's the amount going to be? The amount is going to be 3,665,000. So we have 3,665,000. So we're done with our shareholders' equity, and we have all the amounts that we need. And then we move on to non-current liabilities. So non-current liabilities, we got a loan. We do have a loan. Let's just go back to the information that we got here. So we have a loan from big bank. So the loan. And let us just go and see some of the information that they gave us. So they gave us that it's 284,000. So we have 284,000, and then we need to go to that information that we saw about the loan, which is information I. So they say here there's an extract. So it's 376,000, and then there was installments, which included the interest, and then the interest in those installments was 48,000, and then you have a balance at the end. So they capitalize interest, but what you know about interest is that interest is a separate item in the income statement. So even if it is capitalized, but when we're reporting, in the financial statements, we need to make sure that we separate the amount of interest from the amount of the loan. So in this case, we're also told interest has not been entered in the books, and then they say 50,000. They say 50,000 of the loan will be settled in the next financial year. So what you need to do then in this case is that these 284,000, we need to add the interest, because it's not been added. Because what happens, in this case is that we have the balance at the end, because now we have the balance at the end, and that interest is going to be added to the loan, so that when payments are being made next year, it also includes. So every interest that the company they add it to the loan. In other words, it is compounded to the loan. So if it is compounded, then they're going to keep adding interest every time it is unpaid, so that they can earn interest on that interest. And then you're gonna have to be able to separate that interest when you're doing the income statement, and get the interest amount separated when you're doing the income statement, but include it when you're doing the balance sheet. So we're gonna add 48,000, and then we're gonna subtract the 50,000 that is going to be paid within the next 12 months because it's no longer current. And then in the same breath, I'll just also just write here short-term loan and 50,000. The total in this case would then be 282,000, and it would also be the total in this section, 282,000. So now now we have the total for shareholders' equity, of the total for non-current liabilities, and then what we need else is the total for current liabilities, so we can get to total equity and liabilities. So let us go through current liabilities. So the first one, obviously, we have to trade and other payables. Trade and other payables comprise mainly of creditors control. So let's go here and say trade and other payables. So trade and other payables. So we'll start with creditors control. So creditors control, we have 184,000. As you can see here, we have 184,000. And then if you go on to see some of the new information. So now they said here the electricity account for February 2017, 5,600 was still outstanding. So this is an accrued expense because at the end of the year, you still owe that amount of electricity. So we're going to add 5,600. And then the rest of the information, the provision for bad debts dealt with trade and other payables. For insurance, we already said it's prepaid. Against the rent, that's an accrued income. Net profit, nope. The other one, this is shareholders for dividends. It's not part of it's a liability, but it's not part of trade and other payables. Then the loan statement, we've dealt with that. A share, then the current ratio. The current ratio may be to calculate value for current assets. But let us just finish what we can now, and then once we finish that, you can come back and make sure that we're solving all the other problems that you're not able to solve for now. So all the information that's related to trade and other payables, and the total there is going to be 189,600. And then after that, if you remember, when we were dealing with SARS income tax, we established that it was a liability, not an asset, because the provisional taxes were less than the actual tax for the year. So SARS income tax, let us go. So SARS income tax, so we calculated the tax for the year to 222,000. So we'll take the 222,000, and then we'll subtract the provisional payments. The provisional payments they are given here. Say SARS income tax provisional payments 209,000. It's 209,000. And then the total for that is 13. Sorry, it's going to be 13. Going to be 13,000. My things are not entirely straight, guys, so you're gonna have to forgive me for that. But when you do it with this hand, you can be able to scale for yourself, but it's really difficult to do it when I'm doing it in the computer. And then the last piece of information that would need for liabilities would be the shareholders for dividends. So if you remember the shareholders dividends, we had come into here. They said the directors declared the final dividend of 24 cents per share, and you know that the shares in 875,000. So in this case, we would say shareholders for dividends. 675,000 to the number of shares issued multiplied by 24 cents, which is 0.24, and we would get 162,000. And then now we have all liabilities that we need, and we need to calculate the total 189,600 plus 13,000 plus 162,000 plus 50,000. The total would then be 414,600. So that is 414,600. And then if you look at the last section, the equity and liability, total for shareholders' equity, total for non-current liabilities, total for current liabilities, and we can be able to calculate the total for total equity and liabilities, which is 4,185,000 plus 282,000 plus 414,600, and that gives us a total of 488,000. So 4,881,600. So now we know that the total equity and liabilities is 4,881,600. Cool. So if we know that total equity and liabilities is 4,881,600, we know from the accounting equation that assets is equal to owner's equity plus liabilities. So the total assets then in this case would also be the same amount. So let's just balance our balance sheet straight up. So 488,600 for both, and then we'll be able to work better. So let's start to try and solve some of the unknowns. So we have information here that told us that the current ratio is 2.1 is to 1. So the current ratio, we know that it is current assets to current liabilities. So current assets are 2.1:1. So in this case, to calculate the total for current assets, you would take the total of current liabilities. The total of current liabilities would be 414,600, 414,600. Then you'd multiply it by 2.1. Multiply by 2.1. So multiply by 2.1 divided by 1, because that's the ratio. 2.1 divided by 1, but 2.1 divided by 1 is 1, so it doesn't change everything. But if it was flipped and you were calculating current liabilities using the same ratio, you'd obviously say, take the amount for current assets and then multiply it by 1 divided by 2.1. It would be different that way. So in this case, 414,600 multiplied by 2.1 would give us 870, 660. And then now with cash and cash equivalents, because we have the total, what we can do then would be to take the total 408,880, and then say minus 4. Oh, sorry, let's take the total. So take 870, 660, say minus 408, 880, and then minus 84, 880. And cash and cash equivalents would then give us 377, 700. So now we have all our current assets. And then if we know the total for assets and we know the total for non-current assets, we can just simply say 4,881,600 minus 870, 660, and then we get the total for non-current assets. So let us do that. So we'll say 481,886,600, and then we'll say minus 870, 660. And that will give us a total of 4,010,940. So that's what we get. And now that we know the total is 4 million, and then we're given here, we know the one for 2981. So for financial assets, it should be then, we then just take this, the amount, and say minus 2,981, 290. So we're subtracting the tangible assets from the total non-current assets in order to be able to get the financial assets, which is the fixed deposit. Cool. And then the total after that would be 1,029,650. Cool. And that would be our balance sheet, everyone. So you can see that there's no blank spaces left. So what in this case is that even if you can't find the amount, the totals are going to be very important that you have them, because you can apply the totals throughout, and then you can be able to use the other amounts as balancing figures. Whereas if you were not able to calculate everything here and you didn't have a total, and if you didn't have a total, you wouldn't have been able to calculate this. Whereas if you couldn't find the total or got it wrong, but while you got it wrong, be able to use it correctly and multiply it by 2.1, you would get a mark. And then if you're also able to use this total that is wrong here and subtract these two amounts, you'd get a method mark here. So it's important that you make sure that you're not leaving any blank, because those blank spaces that you leave end up costing you marks, because everything is very connected in accounting. And then let's just go to the last question in this topic, which is 3.3. So 3.3 is based on an audit report. An extract of the independent report of Karen Ltd for the financial year ended on 28 February 2017 is provided. Required as a shareholder, what concerns would you have regarding this audit report? Explain 3 points. So let us read the actual audit report. So yeah, they say we have audited the annual financial statements of Kareen Limited for the year ended 28 February 2017. These financial statements are the responsibility of the directors. And then the opinion now that they are giving, basis for disclaimer. So you're already being told that it's a disclaimer of opinion. So you have to go back to audit notes and find out what a disclaimer is. It's basically when the auditors refuse to give an opinion. They say in the course of our audit, we established that bonuses paid to directors amounting to 9.8 million had not been authorized by the Remunerations Committee. The audit opinion, because of the significance of the matters described above, we have not been able to obtain any sufficient evidence to provide a basis for an audit opinion. Accordingly, we do not express an opinion on the financial statements of Karen Ltd for the year 2017, Bongani and both the Chartered Accountant CASA. All right. So point one that I would list is, so I'd be concerned first that auditors have given a disclaimer and did not make an opinion on the financial statements. And then point two, the disclaimer of opinion will have a negative impact on the reputation of the company. Thirdly, I'd say the share price of the company may lose value in the market, and in the future it will be difficult to obtain funding through issue of shares. So, I mean, these are some of the concerns that I would have. Maybe some other things is that you would be concerned because it means that directors are abusing their position as directors and are not following due course when paying themselves the bonuses, and all these things can have a negative impact on the company. So these are the concerns that I would have, and everything else that you list can basically be valid as long as it makes sense. And this brings us to the end of our session, guys. I hope you have enjoyed it, and just keep practicing and you will get better at this. Cheers.